Ever wondered why the US dollar impacts gas prices in Europe or trade deals in Asia? It's because the dollar is the world's reserve currency. About 60% of global foreign exchange reserves are held in dollars. This means it's the go-to for international transactions affecting economies worldwide. We'll uncover how this single currency, issued by the US Federal Reserve, shapes global events. Imagine a currency so reliable that countries around the world trust it with their savings. The US dollar earns this trust through stability, liquidity, and safety. Picture a world where economic storms rage, yet the dollar stands firm, like a safe harbor. Why this trust? Let's look at the US economy's massive scale. It represents about 24% of global GDP, making it the world's largest economic powerhouse. This size means the dollar is backed by real economic strength. But size alone isn't enough. The U.S. military power and strong legal system protect investors and enforce contracts, building confidence worldwide. In real terms, this means when crises hit, like the 2008 financial meltdown, the dollar remained a safe bet, unlike currencies in volatile regions. Unlike many currencies tied to gold or other assets, the dollar is flexible, a fiat currency that adapts to economic needs. This freedom allows the U.S. to respond quickly to challenges, a key reason why global reserves heavily favor the dollar. These factors combined make the dollar king. It's not just money, it's a symbol of reliability in an uncertain world. After World War II, the devastated global economy needed reconstruction and stability. The United States emerged as the dominant economic power, leading to the creation of a new international monetary system. In 1944, world leaders met at Bretton Woods, New Hampshire, to establish a new monetary system. They agreed to peg major currencies like the British pound, German mark, and French franc to the US dollar, which was itself backed by gold. This system created stability by anchoring global currencies to the dollar. Countries could exchange dollars for gold at a fixed rate, ensuring trust in international trade. However, by 1971, the system faced strains. U.S. spending on wars and social programs led to gold outflows. President Nixon ended the gold convertibility, floating the dollar and breaking the pegs. Despite the shock, the dollar didn't lose its crown. The U.S. economy was robust, its military strong, and no other currency could match its liquidity and trust. The dollar became the world's reserve currency. Most global trade, from oil to everyday commodities, is conducted in dollars. Take crude oil, for example. It's priced in dollars through major markets like NYMEX. Even companies outside the United States often invoice their products in dollars to participate in global markets. This creates a constant demand for dollars, which strengthens its position as the world's reserve currency. This constant demand creates a powerful cycle. Imagine oil producers from Saudi Arabia selling to buyers in Japan, both using dollars for the transaction. The result is a steady stream of dollars flowing through global markets, reinforcing the U.S. currency's dominance. In fact, according to data from 2025, over 80% of global oil trades were settled in U.S. dollars. This isn't just about oil. It applies to countless commodities and goods traded worldwide, from metals to electronics. When the U.S. Federal Reserve decides to raise interest rates, it sets off a powerful chain reaction that ripples across the global economy. Picture this. The Fed is like a captain steering the world's most trusted ship, and when they turn the wheel, everyone feels the waves. Higher rates attract foreign investors chasing those better returns. Money flows into U.S. assets, strengthening the dollar because it's seen as a safe harbor with attractive yields. As the dollar climbs, other currencies like the euro or yuan weaken in comparison. This makes U.S. goods more expensive abroad, hurting exporters in countries like China or Brazil, who rely on selling to America. Take a real example. A 1% interest rate hike can strengthen the dollar by 1 to 2% against the euro. Suddenly, European goods become cheaper for American buyers, but European exporters struggle to compete. For the U.S., this means cheaper imports. But for trading partners like China, it squeezes their profits and can slow their economic growth. It's a double-edged sword in the global marketplace. A strong U.S. dollar acts like a double-edged sword, creating winners and losers around the world. When the dollar gains value, it squeezes other countries by making their dollar-denominated debts more expensive to repay. Developing nations face the harshest impacts, with rising borrowing costs that can lead to inflation or even default. For example, Turkey experienced 70% inflation in 2025, partly because a stronger dollar made its foreign debt repayments more burdensome. It also reduces export competitiveness, making goods from other countries more expensive for U.S. buyers and hurting their sales abroad. However, a weaker dollar can boost U.S. exports by making American products cheaper overseas. But this comes at a cost, potentially causing global inflation as the dollar's decline makes imports more expensive worldwide. The dollar's strength creates a delicate balance that affects economies from the U.S. to emerging markets. The petrodollar system emerged in the 1970s, creating a powerful link between oil revenues and the U.S. dollar. Oil exporting countries sell their crude oil primarily for dollars, and those dollars flow into U.S. banks. This system recycles that money back into global investments, supporting U.S. budget deficits and providing liquidity to the world economy. However, recent shifts toward ruble-based oil sales, like Russia's approach, are beginning to challenge this long-standing arrangement. The U.S. dollar's global dominance isn't without challenges. Countries are increasingly exploring ways to reduce their reliance on the dollar through de-dollarization efforts. For example, BRICS countries, Brazil, Russia, India, China, and South Africa, are pioneering this change by conducting trade in their local currencies or alternatives like the Chinese yuan and Russian ruble. China's yuan has gained significant ground as a reserve currency, becoming a viable option for international reserves and payments. While the yuan and euro are gaining share in global reserves, the dollar still holds over half, showing its enduring strength. However, no single currency possesses the liquidity, stability, and global trust needed to completely replace the dollar. Experts predict gradual erosion rather than a sudden collapse. Can the world ever move away from the U.S. dollar?